Okay, let's just dive right into this. You know, the stock market can be an absolutely overwhelming place, can't it? I mean, you've got thousands of tickers, endless streams of financial data, constant noise from talking heads on TV. Honestly, it's enough to make anyone's head spin. But what if we could actually cut through all that noise? What if we could borrow the rigorous, battle-tested logic of the Oracle of Omaha himself, Warren Buffett, to filter out all the junk and find the true hidden diamonds? Well, that is exactly what we're going to do in today's Explainer.
Here is our roadmap for today. First, decoding Buffett's core logic. Second, filtering the stockpile. Third, Buffett's best stock fits. Fourth, warning signs and value traps. Fifth, the Peter Lynch crossover. And finally, number 6, the final stock verdict.
All right, part 1, decoding Buffett's core logic. Let's get into it.
What's really fascinating here is contrasting two of the greatest investing minds in history. So on one side, we have Warren Buffett, right? The undisputed king of value investing. He demands high returns on equity, extremely low debt, and an unbreakable competitive advantage, which he calls a moat. On the other side, we have Peter Lynch, the absolute champion of GARP. That stands for growth at a reasonable price. Lynch is completely obsessed with making sure you aren't overpaying for a company's growth. Now, while we're actually going to use both of these frameworks today, it's Buffett's strict, unyielding logic that's going to act as our primary engine.
The crucial thing to remember is that Buffett doesn't just buy stocks. He buys businesses, and they have to meet his exact criteria. Think of this framework like an impenetrable fortress wall. To even get a look, a stock needs a return on equity of at least 15%. Its debt-to-equity ratio got to be under 1.0. It absolutely needs an economic moat. It needs a margin of safety in its valuation. And finally, Buffett requires a simple, understandable business. Honestly, if it takes a PhD to figure out how a company makes money, Buffett just walks away.
Let's zero in for a second on the single most critical engine of Buffett's logic, ROE, or return on equity. Simply put, this metric tells us how effectively a company is using investor money to generate profit. It's kind of the ultimate measure of management efficiency. Buffett draws a really hard line in the sand here. He demands a minimum of 15%, period. Anything less, and the company just isn't compounding wealth fast enough to be worth his time.
But, numbers aren't everything. Say a company has a great ROE, but zero protection. Competitors are just going to swarm in and steal that profit. That's why you need an economic moat. This brilliantly illustrates the qualitative side of Buffett's logic. Ask yourself, does the company have a brand so strong they can raise prices without losing customers? Do they have massive cost advantages? Because if they don't have a sustainable edge to protect their castle, they're way too risky for the long haul.
Moving on to part 2, filtering the stockpile.
Okay, consider this a grueling 3-step financial obstacle course. Step 1, we crush the weak. Any stock generating less than 15% on its equity is immediately thrown out. Step 2, we weed out the highly leveraged. If your debt to equity is over 1.0, you are carrying way too much risk. Gone. Step 3, we check the moat and the business model. Is it simple? Is it actually protected? Most stocks literally do not survive these 3 punishing steps. Let's look at the survivors in part 3, Buffett's best stock fits.
We found some towering performers. While our baseline is Buffett's strict 15% requirement, Ameriprise Financial, ticker AMP, blows right past it with a 20.2% margin. They pull this off thanks to a highly profitable wealth management business with incredibly sticky clients. That is a fantastic moat. Then we have Banco Santander Chile, ticker BSAC, delivering a massive 23.2% ROE as an extremely well-run, highly efficient regional bank. These guys right here, this is what true, high-quality compounding machines look like.
And then we have Seneca Foods, ticker SNEB. Seriously, this is practically the textbook definition of a classic Buffett pick. What do? Simple packaged foods. It's completely understandable to anyone. Do they make money? Yep, a 15.6% ROE, clearing our hurdle. Are they drowning in debt? Not at all. They boast an exceptionally solid 0.45 debt-to-equity ratio. Now, it might not be the flashiest tech stock on the market, but in Buffett's world, this kind of reliable, boring cash generator is a thing of absolute beauty.
Which brings us to part 4, warning signs and value traps.
Let me throw a massive number at you, 3.17. That is the ultra-high debt-to-equity ratio of 2 real estate investment trusts from our source list, ARI and TRTX. To put that into perspective, remember that Buffett prefers debt ratios under 1.0. These companies are sitting on a literal mountain of leverage at 3.17, all while churning out a pitiful 4% return on equity. This is the exact definition of a value trap. Heavy risk for almost zero reward.
Let's move over to our wall of shame, because this builds a huge case for extreme caution. Take Whirlpool, ticker WHR. It's a household name, right? Everyone knows them. But financially, it's a total mess. A terrible 5.1% ROE and huge debt soaring past 1.7. Then there's Harley-Davidson, ticker HOG. An iconic brand, sure, but an aging one, with declining operating margins and an ROE just stalling out between 5 and 8%. And Holly, ticker HLLY. Again, high debt and a weak 5.2% ROE. Buffett's logic keeps us far, far away from these dangerous, deteriorating businesses.
All right, part 5, the Peter Lynch crossover. Now, Peter Lynch isn't a competitor to Buffett in our analysis today. He's actually our ultimate valuation safety check. And his favorite tool is the PEG ratio, or price to earnings to growth. It takes the classic PE ratio and simply divides it by the company's expected earnings growth rate. The PEG ratio effectively answers one very simple question. Are you getting a fair amount of future growth for the price you are paying today?
And for Peter Lynch, the absolute ceiling for a good PEG ratio is 1.0. If a stock's PEG is above 1.0, you're paying a premium for its growth. But if it's below 1.0, that means you are getting growth at a discount. A PEG of 0.5 means you are buying that growth for literally 50 cents on the dollar. So we're going to take the stocks that survived Buffett's brutal quality filter and run them right through Lynch's 1.0 PEG threshold.
And here we are, part 6, the final stock verdict.
These are the absolute best of the best. Ameriprise, AMP, and Santander Chile BSAC easily lock in high scores with PEG ratios well under 1.0, meaning they're great companies trading at fair prices. We also see home builders like Lennar, ticker LEN, and KB Home, KBH, making the cut. They boast exceptionally low debt, solid business models, and shockingly low PEG ratios right around 0.3, making them deeply undervalued. These 5 stocks represent that perfect, rare synthesis of extreme value, high quality, and reasonable growth. But listen, there is one clear champion that utterly dominates both tests. Seneca Foods, ticker SENB. It easily clears Buffett's strict quality test with a 15.6% ROE and super low debt. But when we look at Lynch's valuation metric, its PEG ratio is a staggering 0.05. That is almost absurdly cheap. It has strong, soaring earnings, yet the market is pricing it like a total bargain. SENB is without a doubt the ultimate diamond in the rough we were searching for.
Which brings us to the single most important question you need to ask yourself today. The stock market is chaotic, and the temptation to buy into hype is just endless. But we just saw how brutally strict Warren Buffett's core logic is, tossing out household names and demanding absolute excellence in both quality and price. So, do you have the discipline to ignore the noise, apply these ruthless filters to your own research, and simply wait for the perfect pitch?